Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so we're going to talk about the Fed's prediction that they just came out with.
So remember Goldilocks and the Three Bears? Well, we have the Three Bears and Goldilocks. Here we go.
Okay, the Fed's own economists now expect a Goldilocks scenario: no recession, low inflation, and positive growth. They're basically saying they nailed it.
Yep, the Three Bears.
The Goldilocks and the Three Bears.
Yep.
So if you don't know the story of Goldilocks and the Three Bears, Goldilocks goes into the cottage, and in one chair there's a really bad recession.
There you go.
And then in the other, she goes, this is too much of a recession. And then in the other chair, there's a very mild recession. And she goes, no, I don't like this kind of recession. But then the other chair, she finds no recession. Mm-hmm. She says, oh, this is the perfect recession for me. No recession. I'm going to sit in this chair.
There you go.
And the same thing with the inflation chairs and the growth chairs.
Yes.
So Goldilocks and the Three Bears. Okay. All right. So here's the first quote from the article. So what we're going to do is we're going to talk about some of the quotes from the article and then how this affects real estate, because there have been some mischaracterizations of things the Fed said, specifically Jerome Powell, who specifically addressed real estate. Okay. And what his goal was. And his goal is not to destroy real estate. That's been mischaracterized, right, Rhonda? Why?
I don't think he has a goal for real estate in particular. His goal is to thwart inflation and to keep the economy rolling. So his number one goal is to have inflation somewhere around 2%. Then his next goal is for the economy to hum along. And if those two are working properly, then housing will bring up the rear, so to speak.
Okay. Economists from the Federal Reserve Bank of Chicago predict inflation will cool without a recession.
So the governor from Atlanta said the same thing a couple weeks ago.
Right. These were two other guys that said it. I think we have their names in here. Yeah, we got them in here. We're going to talk about them in a minute. In a September report, they broke down the Goldilocks outlook for soft landing scenario. Further rate hikes may not be needed, and inflation could dip below 2% by next year, which would actually be below the Fed target. Now, the Fed target for inflation is 2%, but they've let it. 2019, it was between 2 and 3, and they didn't do anything to it. They just let it kind of chug along, right? It was like, I think I got up to 2.7 or 2.8 at one point,
right?
And they're just like, yeah, it's fine.
Right. So somewhere in that neighborhood is what the Fed is targeting. It doesn't have to be right at 2% because obviously it's a huge economy and you can't be quite that precise.
The other problem is 2% is arbitrary.
It is arbitrary.
We do have the advantage if you look historically, and there's a great book by Ray Dalio where he talks about the history of every economy from the Romans to the Chinese to the Netherlands and all these economies and how they grew and collapsed and how they mismanaged their money supply. So our Fed at least has we at least have the knowledge of this history. Hopefully they won't screw it up. Okay, but the 2%, number one, it's super arbitrary, right? It's not like they don't really, why not 1.5? Why not 2.5? Why is it 2?
So there's actually this story about how we got to the 2.
Okay.
So the story is that back when Alan Greenspan was the Fed chair.
He was the king of the Fed back then.
Yes.
He was a big deal. He was the most famous person. Like Mick Jagger and Alan Greenspan. They were like pretty close.
Yes. So back then, Janet Yellen asked him, what's the perfect inflation rate? He said, well, there is no such thing. There are just all these variables and you have to kind of, I'll know it when I see it kind of thing. So she kept pressing him. And so he finally threw out a number at her. It's 2%. So that's kind of how we got stuck with it. Obviously, the conversation was probably a little more complex than that. But at the end of the day, that's kind of how we got the 2%.
So actually what happened, this was back in the day when the speech to text readers on the screen, and he just sneezed. Excuse me. And then what happened is that the thing picked that up and said 2%. So everyone saw it and said, oh, it's 2%.
There you go.
That's the target. Okay. All right, so here's the quote with the guys' names. The U.S. economy may just skirt a recession after all, and most of the effects of rate hikes have already taken shape. According to Stefania D'Amico and Thomas King, economist at the Federal Reserve Bank of Chicago. So a couple of things in here, Juana. If the rate hikes have taken shape, we know that mortgage rates tend, when we go through these cycles, tend to go 18 months. That's the magic number. 18 to 20 months, I think 16 to 20 months. We're kind of at the somewhere between 18 to 20 months on interest rates, right? So mortgage rates, if the Fed doesn't raise any more mortgage rates, that spread between the 30-year and the 10-year on 30-year mortgage is going to start shrinking back to maybe 2%. And then we're going to start to see mortgage rates fall. And then when the Fed starts cutting, when inflation's under control, then mortgage rates naturally go down. I think that's why everyone's predicting 5.5% or whatever, like in the spring or something.
Right. I think
which I think is probably too low, but still. Right.
I agree with that too. I don't see it dropping quite that dramatically that quickly, but I do see, and we've talked about this before, I do expect rates to drop next year. They may even drop toward the end of this year. We'll see. The idea that the Fed will leave interest rates the same for at the meeting, was it next week?
Yeah, it's next week.
Right. Then that's for the most part, I think it's a foregone conclusion. I think the jury's still out regarding the following Fed meeting, whether that's going to yield the same result. We'll see. But what the Fed said was that the medicine is working, right? And that let the medicine keep working rather than administering another dose. And this is something that we've talked about a lot, saying that the economy is very complicated. It's and it takes a while for all of these measures to percolate throughout the economy and for them to start doing their job. And my hope has been that the Fed would be patient and not continue to act, but let the medicine work. And it looks like that's probably what's going to happen at the meeting in September.
I'm more of a spoonful of sugar kind of economist, right? Yes. I think the medicine is nice, but I'd rather take a spoonful of sugar. Okay. First of all, it definitely worked for mortgage rates because mortgage rates went from under 3. I mean, I know a ton of people personally that are telling me the story of their 1.9% 15-year fixed mortgage,
right?
Or their 30-year that they refied it to something, and that like they're now they're just set for life. They just felt like they won the lottery, and some of these are over $1 million loans, so they have a large amount of money locked in at a very low rate forever. Right. So I think that we saw the effects. Like if housing was going to have crashed, or it would have happened. And yeah, there are some markets that were down 8-10%. But they, like Vegas has been down. I think year over year we end up being like 3 or 4% down, indexed. If you go median, it was more, but that's misleading because we had a lot more sales in the lower end. So, and then the total number of sales were so much less that the numbers don't line up as well. So, because we did that, remember when we showed you our market update for Vegas, when you go by price per square foot, there was just a little dip in prices, but the median appeared to drop more. So you can't really use the median in that case because it wasn't really as accurate as using per square foot, which was about a 3.5% increase. It was a much smaller increase.
Yep.
Overall, right? Okay. The other thing is these two economists, Stefania D'Amico and Thomas King. I just hope they weren't the two who told Jerome Powell that the inflation was transitory. Jerome, it's transitory. Don't worry about it. Let's keep quantitative easing going. Keep buying all these bonds and pushing all that money out into the economy.
Well, at least the Fed has stopped doing that and and they're working on having the economy work as it should without interference.
Okay, here's another technical quote. D'Amico, and I hope I'm pronouncing that right. I think it's D'Amico. I think it's D'Amico. And King pointed to their vector autoregression model as a reason to believe the Fed could hit its 2% inflation target by next year. The 500 basis points of rate increases since last March have curtailed output, and prices are in a downward cooling track. 500 basis points is 5%. Okay? What I think really happened here was they were up partying one night and they got a phone call early in the morning and said, hey, you got to come and we need you to do this presentation. Then they went into ChatGPT and they said, holy cow, we need a really quick, give us some kind of vector autoregression model. And ChatGPT said, okay, here it is. And they just ran into the room and showed it. Said, it says here 2% inflation by next year.
Maybe a little more work than that.
Maybe a little more work?
Maybe.
Okay. Because it's funny was the Fannie Mae, because, what Fannie Mae does is they look at this data and then they have their own economists who specialize in housing. And then they put together their own forecast. But Fannie Mae looks at two really big things. They look at the interest rates, what they expect mortgage rates to be, in jobs.
Right.
Because they think those are the two biggest drivers, which is why when people are scratching their heads going, well, why haven't home prices started coming down? Or, why are they going up again when interest rates are so high? Because the jobs are so low. So you have interest rates high over here, but the unemployment is so low that's the opposite end of the spectrum. If you had 7% 7% unemployment right now, you would have far less. You'd have less people buying probably.
Yes, you'd have less people buying. So, but that's why it's useful to look at all these different models, whether you're looking at the Fed model or Fannie Mae or Freddie Mac or even Zillow or CoreLogic. They all have some value, and the truth, of course, lies somewhere in the middle, right? But I think when you look at it and you think about it, I think it's easier to understand what's happening, and I think it's easier for most of us to get a clear picture of what lines up with what we see as well. They're using all kinds of models, and that's great. And the rest of us are actually out in the real world and see what's happening as well. So all of us have something to contribute to all these models.
And what's interesting is we see the comments that you all put that, some of you are in different markets and you're having a different experience because you'll say, oh, well, in my market, I'm in this area and this is what I'm seeing. And then it may be your hyper local market is kind of weird. Like you're having a lot of inventory, you have no inventory or something like that.
Right.
So here's another quote. It will take more time for those impacts to manifest in the labor market, which has proved resilient through the tightening campaign, but that doesn't mean that more hiking will be needed. Policies reduce total hours worked by about 4 percentage points, or about 40% of the total effect that is ultimately projected. So when the Fed said they needed to stamp out inflation, they're not just trying to treat the symptoms, they're trying to treat the cause of these. And the cause is overheating labor market. And then so employers start going, oh, labor is scarce, I need to start paying more money. And then they pay more money, and then they go, oh, our product costs more, we're going to charge more in the workforce, or we're going to charge more in the marketplace. And then they charge more. And then everyone else goes, oh my gosh, stuff is starting to cost more. So you get this, you just have inflation, right? Just everything's...
Well, it's this feedback loop, right?
Yeah, right.
Yeah. So,
it's more money chasing goods and services, and then, at the back end, you're creating more goods and services to chase the money, and then it just keeps going.
Right.
The other... Uh-oh, we got to sneeze. Bless
Sorry.
you. It's all good. Okay, the other thing, all the Fed wanted to do with housing was stop this 18% a year appreciation and rent increases, right? They didn't really want to crush housing. They just needed it to not. Because remember, we had 2 years where 500 of the 500 largest markets in the U.S. rents went up.
Right. So, but there's a reason for that. It's not that the Fed cares so much about housing. It's that housing makes up the biggest segment of the core inflation.
Yep.
So that was the reason why housing became so important and why it was targeted in this way. Plus, the Fed really doesn't have that many tools, right, in the tool chest besides interest rates. So interest rate was actually very handy to cool the housing market sufficiently to help bring down the rapid rise in rents and home prices, which of course is what caused a significant portion of the inflation.
Unintended consequence: Fed raises rates. That chokes off some demand. It also chokes off supply. We have the shortage of houses in the U.S. The home builders are now going, hey, wait a minute, it's costing us more money to to borrow the money to, buy the land and then get the materials to start to build these houses. So let's not build as many. Plus, we have less people buying potentially because interest rates are higher. And we were going to build 1 million homes last year. It's only built 750,000.
Well, plus their labor costs are higher. We've talked about this in other videos that labor costs for construction are really high, partly because of the employment, the full employment, and partly because the average construction worker is 55 or older. So the whole labor pool for construction is shrinking, which of course is making labor more expensive, and that's something that we've talked about quite a bit. And then the other thing, of course, is regulatory, right? All the permits and everything that goes along with that. That's more expensive because local governments have made it more expensive for builders. So all of that plays into it.
Yeah. Okay. So that was basically the end of the article. Bottom line, sum up the soft landing, what this looks like for people deciding to buy real estate, and what it looks like in a year compared to now, maybe.
So in a year, a year from now, we will be right before the election.
Okay.
We will be post-conventions.
Okay.
We will know who the candidates are.
Right.
And
RFK Jr. and somebody else probably.
So
who knows?
Yeah. So we will know all those things. And what will happen somewhere between, I would say, March and July, is some Fed actions that will be deemed by everybody as influenced by the election.
Spoonful of sugar?
Spoonful of sugar.
Tablespoon full of sugar?
Yeah. So I think that we're going to see that. Whether that means interest rates will go down or some other measure, we will have to wait and see. But I do expect that somewhere between March and July, we will see some Fed action that is going to be definitely seen as influencing, or at least trying to help one side or another, whatever that is. And I think that's unfortunate because I would rather that the Fed stick to their mandate, which is being at the helm of the economy and making sure that we have an adequate money supply and that we have a healthy economy for all of us, regardless of who's in power.
So if somebody's thinking of buying, does it really matter? I mean, we're not saying you should buy now, but no. Do you think you gain anything by waiting a year?
So my sentiment is no. I don't think you gain anything. I think you're more likely to lose, and lose in the sense that inventory will not be sufficient. So if you find a house that ticks your boxes and you can afford it and you still have sufficient savings after you close escrow on it, then it might be a good idea to take a leap of faith and get that house and have a happy life. I think that's more important rather than trying to time the market. We've talked about this a lot. Timing the market is difficult at best, and particularly when you don't have control of the inventory, right? Even if you have the perfect interest rate, if you don't have any houses that you want to buy, what difference does it make? I think finding the right house is more difficult than dealing with the loan. I think the loan is a short-term issue. I think the right house is a long-term issue, and I preference finding the right house over other concerns.
Okay. I agree.
Okay.
I think you're right.
All right. So what do you think? What do you preference? Do you preference finding the right house? Do you preference the interest rate? Do you preference waiting for the market to crash? What do you think the Fed is going to do next year? On the cusp of the election? Whatever your thoughts are, we'd like to hear from you. You don't have to agree with us. We welcome your opinion. Please remember to tell us where you're watching from. And remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.